All right, so today we're diving into some material you sent over
Yay.
about Transamerica's Financial Foundation IUL-2 policy.
Right.
And specifically, we're looking at the chronic illness rider and the long-term care rider.
Right.
Now,
Yeah.
so I think these are really interesting riders that a lot of people have questions about.
Absolutely. And what's interesting about these riders is this is a way to kind of tap into the living benefits of an IUL.
Okay.
Right. So it's not just about the death benefit down the road,
Yeah.
but you can actually access funds before then, which is a huge advantage.
Now, you can only pick one of these riders
Right.
on your policy.
Exactly.
So it's very important to understand, like, what are the nuances between these?
Absolutely. And I think it all comes down to, anticipating your potential needs, right?
Right.
Do you need a lump sum payment for, a sudden health event? Or do we need a steady stream of income for ongoing care?
Okay, so let's kind of define what each rider actually means.
Okay.
The materials here define chronically ill in a very specific way.
They both use similar criteria.
Okay.
So basically, you need substantial assistance with at least 2 activities of daily living for at least 90 days, or continuous supervision due to cognitive impairment
Okay.
for the same amount of time.
Okay, so 90 days is kind of the
Yeah, 90 days is the magic number.
magic number here.
Yeah.
Okay, so if the criteria are similar, like, what's the big difference between chronic illness and long-term care?
So long-term care really emphasizes the expected duration of the care, right? So it's not just that you're chronically ill, but we're expecting that you're going to need care for more than 90 days.
Okay.
So that's kind of that subtle difference between the
Right,
two.
okay.
Yeah. Okay. So how about eligibility?
Okay.
What do you need to actually activate these riders?
So for both of them, they require certification from a licensed healthcare practitioner
Okay.
to prove that you meet the criteria.
Okay.
But the chronic illness rider gets pretty specific about who can't give you that certification.
So for instance, family members are excluded and business partners are excluded.
Okay, so that makes it a little bit tougher, I would think, for some people to qualify if they're relying on family for care.
It could.
Okay.
Yeah.
Yeah.
And it's really to ensure an unbiased evaluation of your condition.
Okay, that makes sense.
Yeah.
And what about long-term care eligibility? Is it similar?
So they add another layer to it.
Okay.
So you still need that certification,
Yeah.
but you also need a plan of care
Mm.
outlining the specific services that you're going to receive
Okay.
and proof that you're receiving those qualified long-term care services.
Okay, so it's a little bit more bureaucratic, it sounds like.
It is.
Okay. So you shared 2 hypothetical scenarios with us. One was Michael, who's 65 and had a stroke,
Right.
and then Cindy, who's 55 and has early onset dementia.
Right.
So let's walk through kind of how these riders would actually play out for them.
Yeah. So I think it's really helpful, right? Because it helps to visualize it.
Yeah.
So let's start with Michael. Under the chronic illness rider, in the first year, he would receive a lump sum payment of $59,444.
Okay. So that's a pretty good chunk of change up
Yeah.
front to kind of manage how he sees fit.
Right. And it's about flexibility and control.
Okay.
Now, under the long-term care rider,
Okay.
he would actually get $6,000 a month,
Wow.
which adds up to $72,000
Okay.
for the year.
Okay. And that $6,000, what is that, like the maximum benefit or something?
Yeah, that's the maximum monthly benefit.
Okay.
And it's calculated at 2% of what's called a specified amount in the rider.
Okay. Is that like a separate bucket of money inside the policy that's dedicated to long-term care?
Yeah, exactly.
Okay.
And it's one of the factors that determines, your monthly benefit.
Okay. That's helpful to know.
Yeah,
So for Michael, the long-term care rider actually pays out more in that first year.
it does.
Okay. And what about Cindy?
So for Cindy, the chronic illness rider would provide $43,083 in the first year.
Okay.
And the long-term care rider would actually be $76,172 annually.
Okay. So again, significantly more
Yeah.
with the long-term care.
And again, it's paid in those monthly installments.
Okay. So we're seeing a trend here. Long-term care pays out a lot more, but it's monthly versus a lump sum.
Right.
Is there anything else to consider there?
Yes. So long-term care rider keeps paying monthly until the death benefit is exhausted.
Oh.
Whereas the chronic illness rider is a one-time payout per approved claim.
Okay, so there's some definite pros and cons emerging here, but before we get ahead of ourselves,
Right.
what are like the key takeaways for each rider? What should listeners be focusing on?
Yeah. So with the chronic illness rider, I think one of the things that really stands out is the flexibility of filing claims annually.
Okay,
Right.
so you can reevaluate every year.
Exactly. Your needs might change each year,
Right.
so you can reevaluate and potentially receive more payouts.
Is that a common thing with these riders?
It depends, but it definitely offers peace of mind.
Ah.
And then there's a potential for favorable tax treatment on those benefits as well.
Okay, that's definitely something to look into further.
Absolutely.
So what about long-term care? What are the big wins there?
So one of the big wins is what's called the indemnity model.
Okay.
And basically, it's like a safety net.
Okay.
So you receive payments based on the daily benefit amount, regardless of your actual care costs.
Okay.
So even if your care costs less than that daily benefit, you still get the full amount.
That's great.
Yeah. And the other thing is that while you're receiving benefits from the long-term care rider, the rider charges are waived.
Okay.
Now, you still have to pay the other policy charges,
Okay.
but that waiver can save you a lot of money.
Okay.
And then remember, even after the main benefit is paid out, there's a residual death benefit of $10,000 that's left for your beneficiaries.
Wow, so there's a lot to unpack here.
There is.
So, both of these riders have exclusions. Are those pretty much the same?
Yeah, there are some overlaps.
Okay.
So both riders exclude coverage for things like attempted suicide injuries from a felony or care that you would typically receive for free.
Okay, so pretty serious uncommon situations.
Right.
Okay. So what about differences in the exclusions? Are there any there?
So the long-term care rider has a few extras.
Okay.
For instance, it won't cover care that you receive in a government facility unless it's required by law.
Okay, so more geared towards private care.
Exactly.
Yeah.
And then it also excludes coverage for services that are covered by Medicare.
No double dipping.
Exactly.
Okay, it seems like they really tried to cover all their bases.
They do.
This deep dive's really highlighting the importance of reading the fine print and making sure that the coverage aligns with your expectations.
It's not just about choosing a rider. It's about understanding the details
Right.
and making informed choices.
Exactly. Now, as we're talking about all of this, and we're talking about Michael, we're talking about Cindy, these are just hypothetical people.
Right.
But how do you, the listener, actually take all this information and choose the right rider for you?
Well, that's the million-dollar question, right?
Yeah.
And it really comes down to individual needs and preferences. There's no right answer.
Right.
But I think we can break down some key questions to ask yourself. It all starts with, envisioning your future needs.
Right.
Are you more worried about a sudden health crisis like Michael's stroke or more of a gradual decline like Cindy's dementia?
Okay. And then how much control do you want over those funds?
Exactly.
A lump sum gives you flexibility,
Right.
but those monthly payments provide that steady stream of income.
It's a trade-off
Yeah.
between, immediate control and long-term security.
And then there's the tax piece, which
Yeah.
I feel like could get pretty complicated.
It can. And you'll definitely want to research the specific tax laws for each rider in your state to understand, the full financial impact.
So there's some homework involved, but this kind of knowledge really empowers you to make the best decision for your situation.
Absolutely. It's about being proactive,
Right.
not just reacting.
Right.
It's about shaping your future.
Now, before we wrap up, I wanted to touch on those specific services that aren't covered by these riders.
Okay.
Even with comprehensive coverage, there are always limitations.
That's right. And it's important to be aware of those gaps.
Okay.
So both riders exclude coverage for care related to substance abuse, unless it's a side effect of prescribed medication.
Okay.
They also exclude attempted suicide, self-inflicted injuries, and care received while committing a felony.
Okay, so those are all kind of situations that fall outside the scope of typical chronic illness or long-term care.
Right.
Okay. So you mentioned earlier care that's usually provided for free isn't covered either.
No freebies.
No freebies. Okay. And then the long-term care rider got even more specific.
Right.
What else is excluded under that one?
So it won't cover care that you receive in a government facility unless it's legally mandated.
Interesting. So it seems like they really prioritize private care over public options there.
Exactly. And then care that's already covered by Medicare is also excluded.
Okay, so preventing duplication of benefits.
Exactly.
Okay, makes sense.
It's interesting, right? We often plan financially for retirement,
Right.
but sometimes we overlook the potential need for long-term care.
Right.
And these aren't just financial decisions, right? This impacts your independence, your quality of life, and your loved ones.
Yeah, it's about having those tough conversations and making sure that your wishes are known.
Exactly. And making sure that your family is prepared,
Right.
both emotionally and financially, to support you if those needs arise.
As we've gone through all this stuff about these two riders, it's clear there's no easy answer. It's all about weighing your priorities
Absolutely.
and assessing your risk tolerance and making the choice that aligns with you.
And that's where seeking guidance from a financial professional can be so valuable.
Yeah.
It can help you navigate those complexities, compare the options, and really develop a plan that's tailored to your specific needs.
Yeah. It's about finding someone you trust who
Absolutely.
can walk you through those decisions and
Mhm.
provide that expertise.
Because ultimately, it's about more than just choosing a rider.
Right.
It's about planning for a future where you can maintain your dignity, your independence, and your financial well-being,
Right.
regardless of what life throws your way.
Well, on that note, we'll wrap up this deep dive. We hope this was informative and
Mhm.
maybe even a little bit empowering.
Absolutely.
Remember, knowledge is power, and you're now equipped with the information you need to make these important decisions with confidence.
If there's one thing to take away from all of this,
Yeah.
don't be afraid to ask questions, seek guidance, and advocate for yourself.
Yeah.
Your future self will thank you.
Until next time, happy planning.